Hey everyone, welcome back to the channel. Today we're diving into another option strategy called the wheel strategy. If you are looking for a way to generate steady income with limited risk, this is one you'll definitely want to understand. And also, if you haven't watched my last two videos on selling cash secured puts and selling covered calls, I highly recommend watching those first and then coming back to this one. The wheel strategy is essentially a combination of both of those strategies previously discussed. So let's go ahead and dive right in. So you will first want to identify a stock that you would like to own. Remember, we want to be always investing in quality companies. Next, you're going to sell a put option at a strike price below the current price of the stock that you've chosen. Remember, this is the cash secured put side, and we are saying that we are willing to buy this stock that we want to own at a discount. This allows you to collect premium immediately, but also obligates you to buy the stock at that strike price if the stock falls at or below the strike price. If the stock price remains above the strike price that you chose, the put option expires worthless and you get to keep the premium collected. If the stock price falls to your strike price or below, you will be obligated to buy the stock at the strike price chosen. So let's say the stock price does fall below your strike price and you're obligated to buy the stock. Now you own 100 shares of the stock that you can now sell covered calls against. So you're going to be able to sell covered calls against those shares and collect additional premium. You would do this by choosing a strike price above the price you bought the shares at. At expiration, if the stock price is below the strike price you chose for the covered call, you keep the premium collected and the call option expires worthless. Alternatively, if at expiration the stock price is at or above the strike price, you are obligated to sell the stock at that strike price. This allows you to make profit in addition to the premium collected because you'll be selling at a price higher than you paid for it. So as you can see, this is a win-win situation. As you are collecting premium for selling a put option, you're collecting a premium for selling a call option, and if your shares are called away, that's even more profit as you're selling your stock at a higher price than you originally bought it for. So this is why it's called a wheel strategy. You are rinsing and repeating these same steps over and over again to earn extra income, starting by selling a cash secured put. That put gets exercised, and now you own 100 shares of that stock at a price that you like. Now you're going to sell covered calls against that stock, and once your strike price is hit, you're going to sell those 100 shares for a profit because you're selling the shares at a higher price than you originally bought it for. You can take the same stock and do it all over again by starting off with another cash secured put and rinsing and repeating. So if you have any questions, please leave it in the comments down below. And if any of this seemed confusing, please go back and watch the previous videos in the options trading playlist that's on the channel. Please don't forget to like, subscribe, and hit that notification bell so you'll be notified when the next video drops. And as always, I thank you for watching, and I will see you all in the next video.